Hi folks, Scott here, and this is the wrap for Friday, August 9th. So this is the price action on the S&P 500 Cash Index, also known as the symbol in trade stations, INX. I believe, and I should know this, but the INX I believe is identical to the SPX. They're just, I'm not sure. Actually, I don't know what the difference is. Anybody knows, email me, scott@masterthegap.com. Sorry, that's embarrassing, I know, but I'd rather know than fake it. But I'm virtually positive the INX and the SPX are the same. Anyhow, what you can see here is that we are forming a wedge, and these can break either way. Pressure's building, and it's probably going to be a pretty decent move. I've seen different measurements and techniques for measuring them. Some people will actually say you can expect the size of the move, depending upon sort of how long it consolidates, to be from there to there. So you can actually take a measured move and clearly imagine it getting down to the 50-day moving average if it breaks down, or clearly, depending upon where it breaks out, putting in new highs. So I don't know. That's not the point of this video today. But I did want to show you the results of fading gaps on Mush Mondays. I just made that up, by the way. Mush Mondays are when you close on a Friday. Maybe you call it a Mush Friday, I'm not sure. But you close on Friday without making a 10-day high nor a 10-day low. So you close right in between, and you're above the 200-day moving average. That's the only criteria. And how do gaps fare following such a scenario? So you go to my back testing tool here, and there you go. Using an end-of-the-day stop, not something I recommend, but a good place to start one's analysis, you can see a couple things. First, odds of gapping up are higher than gapping down. And if we gap up, historically it's been a slight money loser using an end-of-the-day stop. But what's important is that the win rate here is at least 10 to 15 points lower than the typical gap, which has about a 70% gap fill win rate by the end of the day. So this is clearly a riskier setup for shorting up gaps. Now, buying down gaps looks to be pretty normal, if not slightly attractive. What we don't know, though, is how volatile the open may be. So I will rerun these numbers for our members of the morning just to confirm and show whether or not you can buy a down gap using what we consider to be a typical intraday stop of 30% of the 5-day average true range, just to confirm it's tradable or not. And as always, I'll defer to our gap guides and my worksheet and other considerations like Monday of OPEX week is in play next week and so on before I make my final decision. All right, but that's an interesting nugget there. Fading gaps after a Mush Friday, or you can call this a Mush Monday setup. All right, let me show you what we had posted last night around 6 p.m. Eastern Time. Our worksheet for the day, which averages up the 8 individual indices gap guides for the subsequent day, showed that a gap down between the prior close and the prior low was a pretty good setup historically. A 67% win rate and 1.3 on a decent sample size. And that generally means, I'm sorry, I'm just pausing a little bit, that generally means that I'm going to trade it, but not always. One thing to note is that there was a 55% chance of gapping up. Odds favored gapping up in a pretty large sample size today versus gapping down. But there were some other considerations. In fact, you look at these patterns down here below. Down gap after a false down day. Odds are greater for a gap down. After a 10-day moving average up straddle, odds are greater for a gap down than a gap up. And neutral and hammer candlestick. So not real surprised when we gap down, but it was in a decent zone. These scenarios, this is neutral for down gaps, positive for down gaps after a 10-day moving average up straddle, and right at, I'd call that positive, slightly positive for fading down gaps after a hammer candlestick. Definitions are down there. You can pause the video if you want to read them. I tell you what, I haven't looked at the gap guides in a while. Let me show you the individual gap guides just so you get the gist of it. And I want to point out something that someone asked this week. So we were opening between the close and the low. That's the DCL zone. You see the 3 different systems. Weighted average for the S&P 500 futures was attractive. Now, there has never been a gap in the DCL zone after such a 3-day pattern. That tells you how unusual price action has been. We had a false down day yesterday, right? We closed lower than we opened. False down day. We closed right there versus opening a point and a half higher. But we were higher than Thursday's or Wednesday's close, so it made it unusual. But the key thing is this is a weighted average. 0 and 0, and I just misspoke by the way. 0 and 0 means there's never been a winner. There have been some trades. Now you wouldn't know this. It's a tiny, tiny, tiny nuance. But 0 and 0 means there's never been a winner, though there have been some trades. And it does impact the weighted average over here. But you see just above and just below 0 and 10, that doesn't make sense either. 0 and 10 means, when it doesn't make sense like that, it means it's never happened. That's just the way the database is coded right now, or the way the data came out of TradeStation. And it does not impact the weighted averages shown over here because there's never been a scenario. So we probably need to clarify that next time we do a database upgrade, but wanted to point it out to you. So after that little digression, ES good for the zone, neutral to slightly weak for the YM, positive for the NASDAQ, and positive for the Russell, right at my criteria. So 3 out of 4 there. Whoops, looking at the ETFs. A little bit weak here in terms of weighted average, so slightly attractive, neutral to slightly weak there, very attractive here for the NASDAQ, and slightly attractive there. So a little bit mixed, but the total weighted averages I just showed you in the worksheet for those 8 cells was right here. So good enough for me to trade. Nothing that looked terrible down here. Everything was either neutral or attractive. And then in terms of unique patterns, there were some concerns. Almost enough to keep me out of it, frankly. Last night's unique wrap, you can read that, or fact, you can read that. Not much of a concern. Sample size is small, but check this out. Small and mid-sized down gaps on Fridays went above the 200. It's a nice sample size and terribly weak. Fading gaps in August. Ooh. Did we close above the 200? Hold on. I mean above the 10 last night. That may have been a mistake. Yep. Sorry about that. Wow. I'm glad I didn't get overly influenced by that. See the cash index closed right here above the 10-day moving average. So that is a mistake and a pretty significant one on my part. Really sorry. This did not apply. Did not apply. I need to rerun it showing August gaps from below the 10. Nonetheless, it really didn't mess me up. I had enough concern to only trade half size because the guides were not overly attractive. They were only slightly attractive. We had the mixed factors I just showed you. So I said if the ES opens less than 1692, and the reason 1692 was important, that was which I did not point out, but that was the cash close. That's the 4 p.m. close, where the futures were trading at 4 p.m. when the ETFs closed. So if it was opening less than that, I didn't want to have mixed opening directions, so that's why I had that parameter. Then I traded half size, 5-point stop per the guides. Normally I just say per the guides, or if I don't say anything, you can assume I'm using the stop per the guides. We had a bunch of new people this week, and I just wanted to be crystal clear to them. And we opened right here 1691. I actually was filled 1691, no slippage. Over here in the Russell, same zone here in the NASDAQ, and down in the Dow. All of these markets traded up to the blue line, the prior day's close, and then some. In fact, on the worksheet, you'll see data was pretty favorable for the extended target. So whenever the extended target odds, these two numbers shown here, are greater than 80% of these two numbers, but you know that by looking at these, then I'm probably holding some for the extended target. And one more thing, the extended target is shown on the gap guides right here. You add this number, rounded up or down, 1.5 points, add it to the close, 93.75. It made it 16.95 and a quarter, and I targeted 16.95. I went long at 16.91 was filled, scaled out 2/3 at plus 2.5 points, held the last third for 16.95, and I got 4 points on that for a weighted average of 3 points. And 15-minute and first hour range guides came out, did not show a clear edge in either direction, and I did no other trades the rest of the day. So nice way to end the week. Good day, and have a great weekend. Enjoy the PGA if you like golf. I know I will. Take care.